The three big things that are happening today, or that have already happened today, was the Fed. You had a couple Fed speakers come out, and we'll talk about exactly what they said because it upset the markets a lot. You also had the JOLTS job openings, as well as the S&P case home price or S&P Schiller case home price index, right? You guys get the idea. Data about real estate. So let's dive into all of these three different things. And the most important thing that started to drive the markets down in the beginning of trading was the JOLTS job openings. So this says job openings top 11.2 million in July, well above estimates and nearly double the available workers. Key points. Available job positions in July totaled 11.24 million for the month, well in excess of the 10.3 million FactSet estimate. That total also was nearly double the total pool of available workers, which stood at 5.67 million for the month. So if you have two job openings for every person looking for a job, well, some of those are not going to get filled, and that's just a really bad ratio, right? That means the employee or potential employee, the person out looking for a job, has a lot more different avenues they could pursue, potentially getting higher wages, right? Or even these other companies have to start paying higher wages to attract those potential employees. And that's why the markets kind of threw a hissy fit over what this data said today. It's going against the Fed's mandate of stable prices and maximum employment. So there is that. That was at about 8:30 in the morning today, so it did affect the stock market as soon as that did come out. But you also had some Fed speakers like Fed Williams, which pushed back on markets' expectations of a rate cut next year. The key point says New York Fed President John Williams said he expects interest rates to continue higher and to remain at those levels until inflation is subdued. Williams didn't specifically say where he'd like to see rates go, but he did note that he believes reducing inflation will require real interest rates to be positive. Williams, Fed Chair Jerome Powell, and Vice Chair Lael Brainerd make up the central bank's policy brain trust. So what we're getting out of Fed Jerome Powell, Lael Brainerd, out of Fed Williams is the same message of we have to keep raising rates, and we're going to keep rates higher for longer. That you shouldn't be expecting rate cuts in 2023 like the markets are projecting. It's simply not going to happen. So when you get the markets that are upset about, like quite literally upset, but upsetting expectations about future monetary policy, that changes valuations for stocks, for bonds, for everything else. And you are seeing right now the rapid recalibration of valuations of where should these assets be valued, how high or how low should we make them go, and a lot of that is done by trading algorithms. And nonetheless, that's probably why you're seeing a NASDAQ that is down 1.63% today, a Russell 2000 which is down 1.69%, an S&P 500 which is down 1.30%, and a Dow Jones Industrial Average that is down 1.10%. Those trading algorithms are trying to figure out where do we value these companies. So those are the two big things that really happened today. If I were to put, weight, or like which weighting was more important, honestly, I would say the JOLTS job openings just coming in far above expectations. That and the Fed, they're like neck and neck. They're both super important, and they both cause a lot of fear today. But you also have the S&P Case Schiller Home Price Index. So this says home prices weakened in June, but we're still much higher than a year ago, says S&P Case Schiller. The key points: home prices in June were 18% higher than the same period, same month last year, according to the S&P CoreLogic Case Schiller indexes. That's a weaker pace than in May of this year, which showed a 19.9% annual gain. Another report last week showed home prices fell 0.77% from June to July, the first monthly decline in nearly 3 years. So this can be seen as somewhat of a positive thing. You can make the argument they're not coming down fast enough, or that they're just still way too high, and there's potentially a lot more pain to come in the real estate sector. And why is real estate so important to the economy, to the stock market? Well, simply put, real estate is the biggest asset class. Everyone needs a home. Whether you buy, whether you rent, whatever you do, you need somewhere to live. 65% of American adults are homeowners. So, I mean, if you have your asset values going up too much or down too much in a time period, right? We've seen real estate go crazy. That's not necessarily going to be a good thing. If we start to see real estate pull back in a big way, not going to be a good thing. It's not going to translate well for the stock market as well. There's not a one-to-one correlation between stock prices and home prices, but they do tend to feed into each other. Now, with all of that being said, how has that moved the probability of a 75 basis point rate hike at the next Fed meeting? Well, it's moved it quite substantially. We're now looking at a 72% chance of a 75 basis point rate hike at the September 21st FOMC meeting. Now, I will say, in a bit of probably good news, obviously I can't guarantee this, but it looks like from the commodity prices that we have been seeing, or the commodity declines over the past month, that CPI rating that comes out on September 11th should be pretty positive, and you should see potentially a 1% decline in CPI. Now, just all depends on what happens with real estate, what happens with other more sticky components of CPI. But nonetheless, that should come down. If that comes down, then that's really where you want to watch this Fed rate monitor tool a little bit closer, because that's going to be the last data point that the Fed has to look at before we get to September 21st. So that's going to be a big time frame. Definitely want to keep your eyes to that one. And it looks like the market's more and more pricing in that 75 basis point rate hike. Now, if you guys are unaware, as far as economic data for the rest of this week, for Wednesday, that will be tomorrow, you have Fed Mester that speaks at 8 o'clock in the morning. You have some oil data that comes out. You also have Fed Bostic that speaks at 6:30 p.m. tomorrow. But I don't think tomorrow is going to be the biggest day unless Fed Mester comes out and says something that we have not heard yet. Other than that, you have Fed Bostic, which could be a little bit more important, at 6:30 p.m. So after markets are closed tomorrow. So not a lot of economic data, nothing like that comes out that should spook the markets. But still, you definitely want to watch Fed Mester nonetheless. Now, let's talk about AMC, exactly what's going on with this stinking stock today. AMC, let's go ahead and pull it up on the chart. I thought that was AMC, actually. It's Apple. AMC down about 4.17%, not having the hottest day. What's new? It is pretty much the same story. It seems like every single day. You do have a positive order value for the day, 76% positive order value to be more precise. 9 orders totaling $418.21 thousand. So you are in positive territory. You're seeing about a $500,000 worth of options being placed on AMC stock. All in all, a positive thing. Now, you are seeing the cost to borrow max jumping up quite substantially today and holding this level at almost 51% cost to borrow max. Cost to borrow average doing the same thing, jumping to 31.5%, and the cost to borrow minimum jumping as well to 15.41%. So obviously this is a sign of volatility. This means the down days are going to be big, the up days are going to be even bigger, and I think that is what the cost to borrow is really highlighting more than anything. Now, if we look at the short interest, the dollar denominated amount, that is worth $1.05 billion. Estimated short interest of free float, 21.58%. Free float out on loan, 38%. Shares out on loan, 196.5 million shares. Days to cover up 16% over the past 7 days. Now at 4.09, highlighting the lower volume that we have seen with AMC stock, and you are still at 100% share utilization. Now let's go ahead and pull up APE. Let's see if the story is the same over here. Let's look at the cost to borrow first. You have cost to borrow max at 24 0.58%, so about half of what we're seeing for AMC. Cost to borrow average at 18.63%, cost to borrow minimum at 11%. You are seeing the estimated short interest of free float at almost 20%, so a little bit lower than AMC, but still comparable, and 100% shared utilization over here as well. So if I were to choose one stock I want to be in, some people would say the preferred shares because they have more voting power, right? They're the preferred shares. It's like Google. You definitely want to own the preferred shares if you can, but I think for the sense of the squeeze or anything else, I think AMC is definitely going to benefit more from that. It has a higher short interest. It has over double the dollars that are currently sold short on AMC stock. You're getting a 4 days to cover. You're getting a 38% free flow on out on loan and a 21.5% provable short interest. That is very, very high, and I think that is prone for big movements, right? When you get a short interest like that, obviously your down days are going to be bad, but like I said, your up days are going to be really, really good as well. I think the next big up day we see, AMC is probably going to go up 10% or more, right? That's kind of my expectations around that. Might not be a bad time to initiate a bullish trade, right? If we do get some of that bullish momentum, which can come out of these dark days in the markets with relatively short notices or sometimes no notices at all. Now, if we look at the option activity expiring by September 2nd, that is going to be this Friday. You have 3,000 calls that are currently in the money and 69,000 calls that are out of the money. If you can, like I said, break out above $10, which obviously right now doesn't look too likely, but keep in mind we still have Wednesday, Thursday, and Friday. If we could break out above that $10 level, well, you could see some more upside, maybe to $11, $12, or even possibly $13 per share by the end of this week, if for whatever reason the markets decide to turn a little bit more to the bullish side. And finally, last but not least, let's talk about some of the key indicators, technical indicators with AMC stock. Like I said, in between $10.22 and about $13 per share. You have the 50, 100, and 200-day moving averages. These are going to be the key levels to watch for the upside. Beyond that, I've been watching the RSI and the MACD. The MACD extremely bearish, and the RSI is at 36.21, almost in severely oversold territory. So it looks like to get a bounce up to 50 to that neutral level, would entail a 5 to 10%, if not larger, move in the stock. And I think that is really what we're overdue for at this moment in time. You can only trade this low on the RSI and the MACD for so long. So that is going to be all for this video. Hit that like button and subscribe to the channel if you guys have not already. If you guys want to come trade with me live in real time, link down below in the description of this video. And to get yourself free stock, come on now, it's free money. You might as well take advantage of it with Webull, Moomoo, and Public down below in the description of this video as well. Thank you guys for watching, and I will see you in the next one.